So I'm going to talk to you about how to balance consumer protection and consumer responsibility in insurance. In fact, consumer protection has always been at the heart of insurance regulation. It's not a new concept. However, it was considered to be mostly insured through the solvency of the firm, because if the firm didn't go bankrupt, then that's how the consumer was best protected. His the promise the company had made could be upheld when the claim, when the event occurred. In fact, a very long time ago, like some 30 years ago, there was also an authorization process for insurance contracts. And there was even in some countries tariff control. There still is, for example, in the United States. But in Europe, we decided that we wanted modern supervision, which was a posteriori supervision and not a priori. So it was decided to put maybe the prudential rules in the forefront. But then we had the 2008 crisis and the rise in distrust in financial institutions. Also, on the side of the asset management industry, we got MiFID I and then MiFID II. And so the European Parliament felt it was necessary to go back to a certain direct protection of consumers. And that's why we are today in this conference. Just one word, one remark, personal remark. I think insurance got sort of bogged down in Solvency II, which took us, well, over 15 years to develop. And so there's the perception from the other financial sectors that insurance has not wanted to work on consumer protection. I think that's not true. It's just all the energy was concentrated on finishing Solvency II. And so we are now with the pressure to copy and paste what asset management has done in consumer protection, which is excellent work, that's true. But I don't think copy and paste is the right solution. The right solution would have been to let the insurance sector develop its own consumer protection regulation, and then at a later stage to say, well, let's see and compare and try and harmonize between the sectors. But, well, I think we're at the heart of the problem of PRIPS. But to go back to to what I wanted to say, there is a strong asymmetry of information and power between the consumer and the insurer. So it's necessary to have consumer protection regulation. But one can wonder if sometimes it's not going too far and treating consumers as infantile and as not prone to greediness. And after all, they are human also. So I think I'd like to take you through the major consumer protection principles and taking some concrete examples of mainly sanctions which have shown the issues around those principles, and then that we think about potential solutions. So major principles to ensure consumer protection. Well, first of all, forbidding aggressive sales practices. There's been in Australia, that's safe, I'm taking an example outside of Europe, UE, Australian insurer, was fined $100,000 in New Zealand for misleading consumers on the internet. And I think that's interesting because, in fact, they were making false and misleading statements on their website regarding the consumer's ability to obtain a quote online. And they were telling them that their bank or credit card details were necessary just to get a quote. And in fact, the people were actually underwriting, well, buying a contract. And they thought they were just asking for a quote. Now, in fact, in France also, we had a similar case in 2016. So it's important to, it's like Gabriel talked about the risk linked to digitalization. And I think it's important to have clear information whether you're asking for a quote or really buying a contract. So that's one concrete example of aggressive business practice. Also, in general terms, it's important not to have misleading information. So I'll give you two examples of fines for misleading advertising. The first one is pet insurance. In 2016, a major insurer was fined, again in Australia, after it was found to be misleading customers over pet insurance policies. It said that it provided cover for the cost of veterinary expense, for the treatment of injury, accident, and illness in a pet dog or cat. So it was 100% refund on claims. And then you had a small print disclaimer saying that, in fact, this excluded a fixed excess and non-claimable item. So the court decided, well, the supervisory authority that sanctioned this insurer said that you can't give a misleading headline claim and then have the small print saying, well, in fact, it's not completely true. So you have to state the right thing in big letters. And then also, there was an issue around pets when they were over 8 years old. In fact, you had you didn't get 100% refund for those. And so, in the end, the firm had to repay all its customers that had pets over 8 years old by giving them the difference. Another example is a life insurance product, which was called Quick and Easy. Now, this Quick and Easy life insurance product, in 2014, there was also, again, a fine by the Australian regulator. Very active, the Australians. Actually, it's one of the places where they do very interesting things in terms of regulation. I found Australia and Canada very inspiring. One of the, in fact, the application form was saying there would be no health or lifestyle questions. And in fact, the application form had a query around smoking habits. So there was, and the response to these questions were used to calculate the premium. So clearly there was misleading advertising there. So that sounds like good consumer protection and not exaggerating. But now I'll take an example in the opposite direction. There's been an issue in France with pre-contractual information. So in France, there's very detailed rule about the pre-contractual information you have to give consumers. And if you don't give it, the consumer can claim back the original money that it has invested in the product. So it can renounce the contract. So it's not the same thing as a lapse, because it's you go back to the origin as though the contract was never bought. And some very wise consumers have subscribed a very big amount, $1.5 million of life insurance policy at a time when the stock exchange was going up. They have done partial surrenders. It was a couple, that's why I say they. They have done partial surrenders over the years. And then suddenly, when the stock exchange went down, they said they hadn't received the original pre-contractual information exactly in the format that was prescribed by the law. And the court judged that, well, it didn't matter whether they were in good or bad faith. The insurance company had to accept to give back the original amount invested. And so the insurer took a big loss. So that was in 2006, and fortunately, 8 years later, the High Court judged it was necessary to be in good faith. But so this is an example that sometimes consumers are not to be protected at all costs, and maybe sometimes we have to think about how to do things well. So, giving good information it's more complex than it looks, because in fact we have to take into account what we have learned from behavioral economics. So EY has helped a digital firm that was selling through the internet payment instruments. And we noted that 40% of the customers took one specific card. And this card allowed to transfer your former account to a new card in a new bank. So when you changed banks, it was good because then you could transfer and didn't cost anything if you took this card, which had this specific feature. And then we found that 6 months after having bought this card, the majority of the clients hadn't used this feature. So we thought, you know, why? And in fact, it's because in the long list of cards that you could buy, that was the first one. So consumers just took the first one. So they didn't scroll down. So sometimes you have to take into account these behavioral biases to devise your how you have to show information, because it's not enough to have the content, but also the order in which you show the information has a big impact. And Gabriel, you said you were proud about the IPID, and I quite agree with you. I think it's very good. It looks very simple, the IPID, but just having on the same page the exclusions, what is covered and what is excluded, I think is a big step forward. Sometimes it's better to do small steps than to try and do big steps like with the PRIPS kit. I won't go any further into that. It's misleading information. It's about content, but also about timing. So IDD says you have to give the pre-contractual information in good time. That's really complex. It's true that you need to give the consumer the time to reflect, but also people who sell things, they know that usually the sale is done in one go. So how do you reconcile the two? And that's quite a complex issue. And also people want things quickly. They don't want to wait, so they're going to buy it elsewhere if you're making them wait 15 days between the two, between having the information and buying it. So that's going to be a very complex issue, these small in good time in the IDD for everyone. A third major principle to ensure consumer protection is to advise. So in December 2016, very recently, the ACPR in France sanctioned a health insurance internet broker called Santian with a warning and a fine for in breach of duty to advise. And in fact, the ACPR listened to the phone recordings, and the sales staff was saying, well, for dental care, we're the best. We do 200% refund, and we have no limit and no ceiling. Well, clearly that was not a good advice for the person. And also they were saying, well, you can change the date of your invoice so you get covered and repaid for your health insurance. So that's not good advice. Also, there's because of the very low interest rates, now people invest in atypical products, unusual products, such as diamonds, works of art, wine, letters and manuscripts, forests, anything, a lot of different type of investments. And often these type of investments are made on opaque markets, and they don't have the liquidity of financial investments. And that's because they're hoping for higher returns. So do we want to protect investors that go to these markets as we protect investors that go into, that buy more normal insurance products? A fourth principle is that remuneration should not go against the client's best interest. And here I'll take the Wells Fargo case in the US. In September 2016, this American bank was condemned by the Consumer Financial Protection Bureau, CFPB, which I hope will have a long lifetime. But there seems to be some uncertainty because the new administration doesn't share the same view. But it condemned Wells Fargo to the greatest fine it ever issued, $105 million. And it's because in the bank, they opened 1.5 million bank accounts and over 500,000 credit cards that were not authorized by the customers, because the remuneration for cross-selling, for selling several products to the same person, was so high that finally employees opened faked bank accounts and quickly closed them. So sometimes consumers were not aware, but sometimes they saw like a small fee appear, and so they said, what is this fee? Or why do I receive this credit card which I never asked for? And so finally it came all to light, and the CEO has left the company, as well as 5,300 employees. So it's been a big, and Wells Fargo has announced it would give back $2.6 million to its customers. So it's a very costly when remuneration pushes you to act in a very unfair way. Distributors, also it's important that distributors receive adequate training to ensure consumer protection. There in 2016 there was a health insurance startup called Zenefits, also in the US, that was fined. It sold services using the cloud, but also it sold a health insurance contract that was very easy to buy. So in fact it was also a broker, insurance broker. And in order for its employees to be licensed to sell this health insurance contract, it devised an e-learning tool which was automatic. So you turned on your computer and you turned on the training, and then you had you went to home, you went to bed, and you came back the next morning and you had followed the adequate number of hours to be licensed to be an insurance broker. So that was, so employees that didn't have the compulsory training were selling this health insurance policy. So it seems like minimum consumer protection, that the distributor is selling a product he understands, and he also understands about insurance more generally. The sixth principle is that to embed measures to prevent risk of misconduct in the product design. That's what Gabriel referred to earlier as POG, Product Oversight and Governance, in the IDD. In fact, if we had had that, in the UK, we couldn't have had the PPI, Payment Protection Insurance scandal, mis-selling scandal, because you wouldn't have sold PPI to unemployed people who couldn't have claimed this type of insurance. And for me, it sounds a bit like a consumer protection by design that you embed in your product, because it requires the insurer to define the target market, but also all the relevant risks for this target market, and also to have a coherent distribution strategy. So it means that you have to think ahead before you sell the product. And it makes me think of the GDPR, the General Data Protection Regulation, and the concept of privacy by design, to embed these measures from the outset and not later. So it's good. Well, there's an issue around POG in countries where there's compulsory advice. But so I think it's good if you allow the target market to be quite wide open in the countries where there's compulsory advice. But I think POG is a good thing. So in conclusion, how can we make sure consumer protection is adequate? How can we find the right balance between consumer protection and consumer responsibility in insurance? Well, I'll do two remarks. First, you can't just pile it up on the financial institution. You also have to develop financial education. And I appreciate that the Austrian Insurance Federation is doing a lot on that front. I've read the latest Allianz report on financial education, which was published in last November, and where they surveyed 1,000 people in 10 European countries. Well, guess what? The best country in financial education was Austria, and the worst was France. So, and I'll give you an example of a question, just to show you the level. Suppose you have 100 euros in a savings account, and the interest rate is 2% per year. After 5 years, how much would you have in the account if you had left the money to grow? So you had 5 options to answer. More than 102 euros, exactly 102 euros, less than 102 euros, don't know or refuse to answer. So you see, it's not a very complicated question, and yet, well, 30% of people in France couldn't answer it, over 30%. So, well, you see, it's, I think financial education is very important, and we should do something about it. But also, maybe, we should change the way regulation is made. I think instead of seeing financial institutions as being a bit sick and so having to be fed pills one after the other to cure all their diseases, there needs to be a minimum level of trust between supervisors and firms. And firms have a real interest in compliance today. First of all, CEOs and sales staff, they want a long-lasting relationship with their customers because that's the one that's most profitable. A short, if you sell something and the customer is not happy and leaves the next day, well, overall, over time, it's not good for the company. So, but also, there's something good which was inspired by the banking regulation that was imported in insurance, and that's the compliance function. So now there's a real ally for the regulator in the firms themselves, which is the person holding the compliance function. So the compliance function is still a bit, hasn't yet cut the umbilical cord with the legal department, but it is in fact a second line of defense function. So it's like risk management. And so it has to think, take a step back and think about the tests it needs to put in to check that the rules are followed, are complied with. So it is really something very important. As Carol said, I was a supervisor for many years, and I participated in elaborating regulation. But now I'm on the other side of the fence, and I see how complicated are all the operational implications of a rule. So when a well-established and traditional insurance firm tells you that a rule that looks simple is complex to implement, it's probably true because they have IT legacy systems and they have several systems. And so it's complicated to implement this rule everywhere and make sure it's done homogeneously. So it's also, but that's obvious, important to gather the views of consumer associations. I note that for PRIPS there were 2 objectives, in fact, in that regulation. One was better consumer information, and the other one was standardizing the information across the sectors to make it comparable. And I really regret that cross-sectoral standardization took over from quality consumer information. So maybe we could build regulation in another way, by a deeper dialogue with all the main stakeholders. But regulators should stay in the driving seat. So maybe they should set the direction to follow with a few short and clear principles and set all the main rules, but then leave firms to work out the details and to make the detailed proposals. And then the regulators can choose whether they accept or not the different proposals. I was struck by Donald Trump's executive order on 3rd of February, where he set the general principles to be followed for regulation. I don't agree with the content, but I think the fact that he said it's like a 2-page document with the main principles that he wants to be followed. And I think we have to go down on the number of pages our regulation has, and that setting some general principles would be good and easier to implement for firms, which is, after all, what we want for consumer protection. It's that the firms really apply the regulation that are made. Thank you very much.